Good afternoon, everyone. Thank you for joining us for our low-income designation webinar today. We'll get started in the next 4 to 5 minutes. In the meantime, we'll be using the Q&A function if you have any questions. We'll take those questions closer to the end. You can find the Q&A section at the top ribbon if you look up right next to chat. You can also throw it in the chat and we'll be able to answer any questions that you have near the end. There'll be a recording of today's webinar. It will be sent out from marketing at CUCollaborate.com. It will also be posted on our YouTube. So if there's anything that you want to go back and visit, or if you have any questions, you can visit that through the email or go to our YouTube channel. So we'll give it about 3 more minutes as people start coming in. And then I'll hand it over to Laura and Jason to kick off the meeting. For those that are just joining us, we will be using the Q&A function for any questions that come up today. You'll be able to use that in the top ribbon at the top. Friendly reminder that this will be recorded and you will have access to the recording after this session. If there's any questions that happen to come up after you see this session, feel free to email anyone at CUCollaborate and we'd be happy to help you. We'll get started in a couple of minutes and I'll do some quick introductions of our speakers today and then we'll get it kicked off. Okay, so I'm going to get us started. Once again, thank you for joining us for our maximizing your credit union's potential with a low income designation. For those of you that are new to CUCollaborate, so we are a data and analytics CUSO that helps credit unions maximize growth, impact, and performance. If we can go to perfect. We empower credit unions to adapt and thrive by leveraging proprietary data and technology alongside deep subject matter experts, just like you're going to hear from today, to drive smarter strategic decision making. Next slide, please. So there are a variety of areas that we can help you, either on the growth, performance, or impact side. Today, we're going to specifically focus on impact with the low income designation. Next slide, please. So Jason Rustin, who is our advisory director, and Laura Gooding, who is our senior advisory consultant, will be handling the presentation today. They work with our different clients across low income designation as well as on the CDFI side. And I'm going to hand it over to Jason and Laura to kick us off.
Thank you, Lucas. Go to the next slide. All right, good afternoon, and thank you all for joining us today. So we are here to talk about the NCUA's low-income designation, what it is, why it matters, and how your credit union can benefit from it. But before we dive into the specifics, I want to take a few minutes to zoom out and look at the bigger picture, what's happening across the credit union landscape, and what that means for institutions of all sizes. So this first chart paints a pretty stark picture. Starting in 1970, we go from nearly 24,000 credit unions in the United States, and fast forward to today, and that number has dropped to just under 4,800, a decline of more than 80%. Though the pace of consolidation has slowed a bit in recent years, the trend is still downward. The industry is shrinking, and with that shrinkage comes increased pressure on those that remain. Simply put, running a credit union has never been more challenging. Next slide. So let's dig into what's driving that pressure. Today's credit unions are navigating a complex set of operational and strategic challenges, from legacy technology systems that are expensive and difficult to modernize, to rising labor and tech costs, to a regulatory environment that continues to increase in both scope and complexity. You're also contending with economic headwinds like inflation and interest rate volatility, while trying to address strategic issues like attracting younger members, managing traditional seg-based membership models, and keeping up with a rapidly changing marketplace. Put simply, credit unions are being asked to do more with fewer resources and to compete in an environment where the rules and expectations keep shifting. Next slide. But when we look deeper into the data, we see that some credit unions are faring better than others, and the common denominator is scale. This chart shows the 10-year average for asset growth and return on average assets by size and tier. What you'll notice is that performance steadily improves as asset size increases. Credit unions with over 10 billion in assets saw 10% annual asset growth and an ROA over 1%. Compare that to institutions with under $10 million in assets who saw just 0.4% growth and a return on assets of 0.11%. This gap is significant and highlights the real structural advantages for larger institutions. More resources, more pricing power, more capacity to innovate. For smaller sized and mid-sized credit unions, this raises a key question. How can we access tools and strategies that help us compete and grow sustainably? Next slide. One of those tools is the low-income designation. Size isn't the only driver of performance. When we looked at the data comparing LID-designated credit unions with their non-LID peers, we found a clear advantage for those with the designation. LID credit unions had a 9.4% annual asset growth compared to 7.0% for non-LID credit unions. Return on average assets averaged 0.91% for LID credit unions compared to just 0.79% for non-LID credit unions. These benefits are not a coincidence. The low-income designation opens the door to important advantages: access to secondary capital, grant funding, exemptions from member business lending cap, and more. In a time when growth and sustainability are increasingly tied to scale, a low-income designation can act as a strategic equalizer, helping credit unions of all sizes pursue their mission and remain competitive. With that, I'll turn it over to my colleague Lara, who will take us through what the designation entails and how CUCollaborate can help your credit union obtain it and retain it. Lara?
Thanks, Jason. So as Jason mentioned, there are several benefits to a low-income designation. I'll step through those at a high level to get us started. So the first is to accept, or the ability to accept non-member deposits from any source up to the greater $3 million or 50% of your total shares. This is especially useful for credit unions that are undergoing mergers and acquisitions because it allows you to take on those deposits while you're still in the process of memberizing those individuals. There's also the exemption from compliance with the member business lending cap of 12.25%. So if this is a key part of your strategic plan, if you do a lot of member business lending, this can be a way for you to continue growing those products. Then there's ability to apply for technical assistance grants and low-cost loans from the NCUA's Community Development Revolving Loan Fund, or we always just say CDRLF, which kind of rolls off the tongue. And that is helpful for credit unions of smaller asset sizes. Then there's the ability to include subordinated debt in the net worth ratio calculation. Finally, this last bullet, it's generally limited to federally chartered community credit unions, but it gives you the ability to expand membership to others affiliated with your community, such as people who perform volunteer services or participate in associations. It's another path to membership for individuals who may not be exactly within the confines of your geographic field of membership's footprint. So, as Jason was mentioning, we know that there's a clear advantage to having low-income designation, but we also know that it's hard to get LID and it's hard to keep LID. And part of the reason for that is because it feels like a moving target. This is an image of all of the low-income designated geographies mapped across the United States, matching the NCUA's LID workbook. The NCUA publishes a new workbook annually, usually around late spring, and it's updated according to the latest American Community Survey 5-year data. So right now the workbook is based off of 2019 to 2023. Next year it'll be 2020 to 2024, and that's why those numbers shift. It gives you a list of census tracts, census block groups, and counties that meet the required thresholds to qualify as low-income designation. Right now, with the current LID workbook, which is again reflected here and in our software, about 61.5% of the United States population is within LID qualifying geographies. So it's generally a favorable time to be working towards LID. But again, we know that can change and that can feel that it can feel uncertain or unsteady. And that's something that we can help you guys with at CUCollaborate. So there's 3 potential paths to LID attainment. The first is the most common, that is through your actual membership, looking at analysis of your Aries file and how many of your members qualify and how many don't. Then there's the low-income community, which is limited to federally chartered community credit unions, and that is looking at your potential membership, seeing if the majority of your potential membership is in low-income qualifying geographies or not. And then this third path, a loan analysis, is providing a random sampling of your loans to the NCUA for analysis and demonstrating that most of your borrowers are from low-income geographies. I'm going to focus on the Aries and low-income community options here because the loan analysis route is not as tested, but it is still a valid way of approaching LID attainment. So starting off, looking at your actual members, you're trying to get a simple majority, that 50% plus 1 threshold. That we at CUCollaborate as closely as possible mirror how the NCUA is going to analyze your file, and that is how we've come up with this guidance here. The first way that your members can qualify for LID is if they reside in one of those low-income geographies listed by the NCUA. So that's, again, at the tract, block group, or county level, not zip code. Then there's high school aged members. So maybe if they don't live in a low-income area, they can still qualify for LID based on their age, ages 14 to 19. Now, these members are prorated a little bit. So a high school student is not going to count as one. They usually count for between 0.75 and 0.95. And that proration is dependent on the average attendance rate of the state in which that member lives. So it can be a bit of a mouthful, but again, this is something that we can help you model. Then there's college, university, vocational school students. These individuals are not prorated the way that high school students are, but we do have to provide the NCUA with methodology on how these students were identified, and they can be kind of particular in the specificity of identifying these students. And then finally, there's active duty military members. So like high school age members, these are prorated at about 53%. And you have to provide methodology to the NCUA of how you identify the active duty military members. Generally, this list is the order in which I would make recommendations, because geography is going to be where you see the most impact. Military members, I don't recommend starting there unless you have a significant military population. Because of the effort required to identify these individuals, you may not see the needle move as far. Then members who do not qualify. So the obvious opposite, residents of non-low-income areas. Then members with P.O. box addresses. We know this can be a little tricky, especially for credit unions in rural areas. The reason they don't count, though, is because a P.O. box can't be geocoded. For example, I live in Denver, mostly low-income designated geographies, but I could have a P.O. box in Breckenridge, which is mostly not low-income qualifying at all. But if you were to see my member record and my mailing address was that P.O. box in Breckenridge, you don't know where I live. I could live in Denver, I could live in Breckenridge, and there's no way to know. And so because of that, the P.O. boxes are counted as not qualifying. Then there's members with business addresses. So also a little bit strange, we know, but because credit unions, you track businesses based on the account type. This is done based on the address itself. So the United States Postal Service has a residential delivery indicator that indicates if an address is a business or not. If your member's address is on that list, it is counted as a business and therefore not counting towards LID. So that was an overview of looking at your actual members. Potential members are another route to obtaining LID. Now, again, this is limited to federally chartered community credit unions, and to help think about the difference, why, if you think about the geographic bounds of a membership, we're looking at your potential members. The aim here is to get more than 50% of your potential membership in a LID qualifying geography. And if you have the majority of your potential members in low-income geographies, then you can qualify for the designation. This does mean a field of membership expansion, but to help show you what that can look like, this is for the same credit union. The left side is what their current field of membership looks like, and it only has 32.34% LID qualifying population. However, with this expanded field of membership, we get it all the way up to 50.67%, which is LID qualifying. We have a tool at CUCollaborate called Report Builder that allows you to plug in your data and your goals so that you can maximize the potential geography and still have it be within the bounds of NCUA regulations. So for example, here you get above that 50% marker for LID population, but your population density is small enough and your population is small enough that it can still qualify as a rural district. One other note here, this is a great example of creative ways to help solve real problems faced by your credit union. You can probably see that map number 2 has some holes in it. And so there's areas where potential members, or areas that people qualified for membership before, where now those areas no longer qualify. And this comes back to that affinity clause that I was mentioning about the benefits of LID, where that can kind of bridge the gap and allow you to memberize people who participate in associations in that community. Thus, you don't really lose the field of membership where those holes in the map are. This isn't always the strategy we recommend. As you well know, field of membership expansions and changes can be kind of a complex process, but this can be an option if, for example, member business lending is a key part of your lending strategy and you're bumping up against that cap. But your actual LID percentage is quite low and it would take a long time to be able to move that needle. In that case, this could be a valid strategy to help get you to that 50% mark, and then you don't have to worry about surpassing the business lending cap, and you can keep pursuing that strategy for your credit union. So generally speaking, key steps in LID attainment, there's 5 of them-ish, and steps 2 through 4 are cyclical until we reach the goal. We start off by determining the baseline. So we take your Aries file and we analyze where do members live, who is LID qualifying, and then we look at opportunities to improve that data. Can we add dates of birth? Are there unknown addresses? Are there lots of PO boxes? In conjunction with that, we look at data enrichment opportunities. Can we add information to further identify additional LID qualifying individuals? So for example, college students. Can we identify all your college students? And that will increase your overall LID member count. And then after all of those steps are done, if you're not at that 50% mark yet, we look at strategic member growth. What are ways that you can get people in the door of your credit union that are LID qualifying? Are you marketing products and services that attract low-income qualifying groups? Are you being strategic with your outreach to make sure that those are the groups that you're connecting with? And eventually, with continued monitoring and iterating steps 2 through 4, again and again, we will get you to the point where you can submit to the NCUA, have them review your data, and ultimately get that low-income designation. CUCollaborate has a lot of ways that we can help, a lot of software solutions that can reach all of those aims that we were just talking about. I'll throw the names of them at you and then I'll show you how to use them because I think how you use them can be a little bit more relatable. The big picture is there's the Analyze CU LID report. So look at your data, learn things about your data. Then there's Expand CU, which is our mapping software. So you can visualize your field of membership, your geographies of interest. You can understand low-income designation geographies proximal to potential branch locations. There's a lot of different ways you can use that software. And then finally, our LID API, which at a very high level, enter an address, output a result if it is yes LID qualifying or no LID qualifying. So all of those things come together into these strategies that can help you improve your LID percentages. So Analyze CU, the tool that's input data, understand data. This can help you identify data enrichment opportunities, model high school students, identify college students. The screenshots that we've got here are some examples of what that analysis looks like. So you have a really good on-the-spot understanding of where your numbers sit and ways that you can move that needle. It also allows you to stay on top of potential changes. Maybe if there's changes to your membership, maybe you're in the process of clearing dormant accounts, or you're pursuing a merger, or the LID workbook changes. All of these things can impact your LID numbers, and by continuous monitoring and being able to see what those results look like, you have the ability to be nimble with your strategies and be proactive on increasing your LID percentage instead of having to react to a scary letter from the NCUA that tells you you no longer qualify. This also has the ability, you can look at change over time, and you can export a really granular report of where your members fall, so that way you have that data to be able to make informed choices about marketing, about how members are engaging with the credit union. All those tools can also help you with your marketing efforts. So this is another example of our mapping software, Expand CU. As I mentioned, I live in Denver and I got to make the slides. So this is, we're zoomed in on the address of Denver's Capitol building, which is something you can do in the software. Type in specific addresses, areas, cities, and then you can get an understanding of how that relates to LID qualifying geographies. And in turn, that's updated every year with the LID workbook. Now, this is just like a tiny bite, like a fun size bite of the things you can do in our software. You can look at your field of membership rules overlaid with LID geographies, or where your current members are, or the population density of different areas. And all of these things can help you make decisions about where you want to market, or maybe community partnerships that you want to establish, or are there geographies where you're interested in building a branch? And all of this information can be useful for that effort. There is also, we can support with LID marketing lists. So that is, we help you get a list of potential members in a requested geography that are all LID qualifying. So if this is something where you don't have the contacts and you want to make sure that you're working or that you're doing outreach, specific outreach to LID qualifying individuals, that is another way that we can support. Finally, that LID API, what I mentioned, where input address, output answer, we use that API to confirm LID qualification for applicants and members. CUCollaborate, we have several lending and member acquisition partners that offer a variety of asset classes and loan types. Partners can deliver applicants, potential members, through forward flow lending arrangements, embedded financing and merchant lending, and also targeted marketing software. Routing people, it's another route to bring people to your credit union. We also have vetted all the partners to ensure that we can support credit unions of all types. This is something where we've seen a lot of success with other credit unions who have implemented forward flow lending partnerships. It's been a way for them to increase their LID percentage and also have that peace of mind that their LID percentage is always increasing, even in the face of potential workbook shifts. So wanted to talk through a recent success story. I've given you a lot of hypotheticals, but sometimes it's helpful to just see it in action and see how this low-income designation and CUCollaborate can really benefit your credit union. So this is Everence Federal Credit Union. They mostly serve a faith-based membership. They're headquartered in Pennsylvania, but they also have branches in Virginia and Indiana. They're a multiple common bond credit union, about $444 million in assets. And the triumph here was that we got them from 45.44% in a cure period up to that 57.4% and got them out of the cure period and reestablished their LID. That cure period that I mentioned, it's what happens when the NCUA notices that your LID percentage has dropped below the 50%. And while you do have a buffer period to get back above the 50%, it can be stressful for the credit union if you're using all those benefits of low-income designation. So we want to help you get out of that cure period as quickly as possible. So we helped Everence in several ways on their LID journey. High level, it was with data clarity and cleanup, our mapping and analysis tools, and then also the function of ongoing monitoring. Matt Lehman very kindly gave us some their VP of Finance very kindly gave us some testimonials that I won't read them to you because that is awkward, but I will give you a high level shape of some of the things that they found beneficial for the credit union. He did mention that having a way to clean that data up and be tactical about identifying if members were LID or not was really helpful for them. I also was really excited that they used our software and the dashboard to pull up in a board meeting, and they were able to say with data points available right then, this is why we want to focus on these different things. Here's where different opportunities are. And it also helped them in determining where to open a branch in order to continue growing their lid percentage. So the way that Everence uses low-income designation, there's a lot going on here. One of them is that member business lending cap. They have a membership that does a lot of, or that has a lot of businesses. Their community really values entrepreneurship. So they wanted to be able to continue growing those offerings for those members. Additionally, they want to walk the walk, talk the talk, and have that affirmation that their business values align with their mission and vision of being able to help people. In general, Matt also shared with me that in the quest of maintaining their lid, they've learned a lot more about their members in different areas, and they're hoping to be able to take what they've learned and replicate those lessons as they continue growing into new geographies and into new branch options. So I'm gonna pause there, and we're gonna make some space for questions. I know that we've covered a lot in this last half hour or so, but yeah, Jason and I would love to hear from you all and answer some questions.
As a reminder, if you have a question, you could pop it in the chat, or you can use the Q&A function that's at the top of the screen. You'll also get a recording after this, so if there's any questions that come up after the presentation, feel free to either email marketing@CUCollaborate.com, or you can email any of the presenters today. We'd be happy to help. We'll give it just a couple minutes to see.
Oh, I do see the comment from Jordan about putting the link to book a meeting. Yes, we can put that link in the chat, and like following up after this, we'll make sure that's in there.
Yeah, we'll make sure someone reaches out to you, Jordan, to schedule a meeting as well. Great. If there's no questions, thanks for joining us today. As I mentioned, you'll get the slide deck as well as a recording of today's session. If you, like Jordan, are interested in learning more about our low-income designation services, feel free to reach out to us at CUCollaborate.com, or there'll be information in the follow-up email.
Oh, looks like
We had one last question pop in. How do you obtain loans to qualify?
So this is kind of a big question. Are you asking, Kevin, are you asking in terms of like using the loan analysis, or are you asking attracting potential members through loans that then increase your member count? Attracting members. Okay, so there's the one that there's several here. So Jason, also feel free to jump in. One of them are those partnerships that I mentioned. So we have the most, we've seen the most uptick with the National Auto Loan Network. And the way this works is, let's say your credit union has membership with us and you've partnered with NALN, and I want to go buy a car. So I go into the membership, or I go to the dealership, I fill out my loan application, and that car dealership, if they work with NALN, they're going to run my information. They see it's lead qualifying, they route me to you, to your credit union as a potential borrower. And then to take out a loan, I have to become a member. But then if I'm in that low income qualifying area, then that's one more member in your count of low income qualifying individuals. So that's one potential route. There's also increasing products and services, or marketing products and services that are intended for individuals who fall into those categories. So maybe if you have loans that are specifically for college students, that could be another way. Just an example, because for them to take out the loans again, they have to become members. So finding ways to resonate with people that are in those groups and then get that uptick in engagement. Jason, do you have other suggestions?
Sure, I can elaborate a little bit on how the forward flow lending partnerships typically work, just building off of the example that Lara shared. We have partners that specialize in different asset classes. So whether you're looking for, vehicle loans, that's what the National Auto Loan Network specializes in. We've got partnerships that focus on home equity lines of credit or HELOCs. We've got other types of consumer debt. So depending on what asset class you're interested in sourcing, the lending partner will work with you to set up a purchasing arrangement where you'll define the parameters of the types of borrowers you're looking for, the credit score ranges, basically all your underwriting criteria, and then the volume that you're looking to pick up. And from there, they will go out and source loans from borrowers who are eligible for membership in your credit union, who also are within low-income qualifying areas. They use our software to determine whether a borrower is in a low-income qualifying area, and then they would use your underwriting criteria to determine if the borrower is one that will be qualified to take on a loan. Most of the arrangements that we've set up have the credit union retain the decision authority, but it is possible to set it up where it's a true indirect lending relationship where the actual partner is making the credit decision. So a lot of flexibility there, but either way, it's a way to directly add low-income qualifying members to your credit union.
Were there any other last minute questions? Great. Well, thank you for attending today, and look out for the email with more information about today's session.
Thank you, everyone.
Thank you.
Thank you. Take care.